Hello everyone, hi, welcome to the channel of Wall Street Mojo.
Watch the video till the end, and also if you are new to this channel, then you can subscribe us by clicking the bell icon.
Today we have a topic with us is EBITDAR, that is earning before interest, tax, depreciation, amortization and rent. Now we'll try and understand this formula in a very detailed format. Let's begin with the formula here as it is written here. So net income, you add back because you don't want this. You want this to be taken into consideration. So you are adding it back. You want them to be considered in terms of coverage. So you are adding back, interest, taxes. So you're covering up the debt holders, you're covering up the government, you are covering up all the non-cash expenditures and the rent. So post facto, what exactly remains is your EBITDAR. So first, what is EBITDAR? Well, EBITDAR is earning before interest, tax, depreciation and amortization and rent or restructuring. So it is used as a measure for the financial performance and of the companies where the rent expense is very high. Okay, now this is a very crucial factor in the valuation of business. Like, shipping, you have airline companies, those who need to pay huge rent amounts every year. So they need to take this into consideration. It's not only the debt holders, it's not only the tax people, that is the government, but when they have a huge exposure to such level of expenses, then that needs to be taken into consideration. So for that reason, they need to be added back and to see how much profit remains for them, right? So this is why it is considered. Understand things in a very logical manner so that your fundamentals and basics go really well to handle all the complex situations. Now, see, while determining the value of the kind of the business, analysts mostly considers EBITDAR over EBITDA to calculate the pure operating cash flows, as it computes the operating income. Now, before deducting interest, taxes, depreciation and amortization as well, rent expenses, which are substantial expenditures, okay, they are the items in the profit and loss account or the statement of this company. So it also denotes that it is the ability of the business to generate profits. So even spending huge rents or restructuring cost as a part of the business operations. Okay, now I'll go with the meaning of this particular topic. See, as an EBITDAR is a calculation of earning of the company, that is before netting the interest, taxes, depreciation, amortization and rent or restructuring. Okay, so this is how the formation will go, and the cost of the company, and it is used to basically determine the actual operating performance without taking the effect of the financial and investment decisions. So it excludes all the non-cash expenses and all the non-operating and non-recurring expenditures. Okay, so unlike EBIT, it's not like non-GAAP measure and does not mention in either classified or non-classified financial statement of the company. It's mostly used to differentiate two companies within the same industry. So those are having different asset structures. Now, while calculating the EBITDAR, the purpose behind adding back the rent is treated as the sunk cost, which means that the cost has already been incurred or certain to have occurred in the financial statement of the company, irrespective of its performance. So R stands for rent or restructuring. Okay, this is the meaning, right? Now, which means the cost is already, so here in the industries like hospitals, airlines, shipping, wholesale trade, the rent cost is very significant and many companies need to spend a lot of their money in the form of just rent, just to occupy the operating space for conducting their business at a desired location. So while evaluating a target company from one of these industries, the analysts must consider the total rent, okay, that is the cost paid by the company during a particular period, and added back in the EBITDA to determine the operating potential for the business. So without considering the adjustment for the rent cost, the company might have poor operating profits and due to large rent expenditure, but it means that it may have very good operations that can generate handsome money from its core operating performance. So by neglecting these factors, the probabilities of missing good target option will also increase. So just like above, restructuring cost is also added in the net profit of the company along with other components while calculating the operating profit of one of these target companies, because restructuring of land and building is a non-recurring cost and shall not be incurred again at least in next, consider, 3 to 5 years. Instead, it can be treated as the potential investment within the business that will help to generate additional revenue and profits to the company. So it helps to evaluate the long-term operating efficiency. Right. Now, hence, it is basically the most appropriate practice among the technician to estimate the EBITDAR while measuring the valuation of the companies. And thereafter, you compare it with the other potential target companies. So you get some real good numbers out of it. Third, we'll take over here as a part of an example to understand this. Now, let's say your net income is standing at $1 lakh, or let's say $1 million. This is standing at $1 million. Let's say your interest comes down to $10,000 of $1 million. Your interest is somewhere close to, let's say, $1 lakh, because it is having the major chunk over there. Taxes somewhere closely that. Depreciation, let's estimate closely around $50,000. Amortization around $50,000, and the rental expenditure, which is highest, let's say $2 lakh. So now you need to add back things over here. So as we have already discussed, the analyst uses as an operating tool and calculate the EBITDAR by adding all these components of interest, taxes, depreciation, and amortization, and rent and restructuring expense in the company's net income. It means that it considers the outcome of the operating decisions only, and it excludes the impact of other non-operating as well as the non-recurring decisions. So the formula will remain the same. There's going to be no change. Net income, that is the NI, plus interest, plus taxes, plus depreciation, plus amortization, and plus rent. So here is the detail with us. So how we are going to do, it's as simple as that. Just add back everything. Here's your answer. As simple as that. You have added all of this item. Or to showcase how things have worked out, you can also do this way. You add back the sum of all of this. The answer is going to remain the same, just for a visibility. Well, this is how the example goes. Now the important part. See, these are the key financial metrics, EBIT, EBITDA, EBITDAR, EBITDARM. So what are this? We'll try and get into all of these terms quickly. The first and the foremost is the EBIT. Now, earning before interest tax are the most common terms that are used to define operating performance of the company in any industry. So it estimates how much operating cash a business can generate in a financial year just by netting the operating cash outflows from the operating cash inflows. So one can calculate the same by simply adding back all the interest, tax expenses, and to the net of profit of the company. Second, you get EBITDA. So earning before interest, tax, depreciation, amortization is used to estimate an actual operating cash flow, and a company generates after deducting all the operating cash flows and depreciation, amortization as well. So it does not consider the non-cash items like actual cash outflow. Hence, added in the EBIT to determine operating result of the company, and we have to add depreciation, amortization cost in the EBIT of the company. Third is EBITDAR. Now, earning before interest, tax, depreciation, amortization, and rent cost are little different from the EBITDA, as it also adds back the rent or the restructuring cost in the net income along with other companies. So, it is necessary to calculate the EBITDA for every industry in which rent or restructuring cost is very high, so that the financial performance of the company can be measured with the utmost accuracy. Then we have the EBITDAR. Now, what is this? So this over here, the ad is M. M is your management fee, right? And is one of the financial measure which treats management fee as a non-recurring items and should not be considered as an operating expense in some sort of industries like NBFCs. Management fees usually paid by the companies to investment bankers, fund managers to manage their portfolio to make efficient investment strategies for the company in the professional way. So this fee is calculated on the asset under management. So AUM, and it also ranges between 0.5 to 2% on AUM. So let me give my final thoughts on this. Final is that this is the industry specific measurement tool which is used to do the precise valuation of the companies between the same industry, but having a substantial rent or restricting component in its cost structure. So the operating efficiency and profitability of like airline, hospitality, shipping, wholesale trade can be determined by calculating the EBITDAR as a part of the investment analysis. And a positive or a negative EBITDAR is necessary to know the operating soundness of this business. And this is also used in to identify and implement operational changes if any required before taking any strategic or tactical decision.
So that's it for this particular topic. If you have learned and enjoyed watching this video, please like and comment on this video and subscribe to our channel for the latest updates. Thank you, everyone. Cheers.